All right. So again, sorry. Thank you for joining us today. My name is Mike Strodman, and I'm with Blue Skies Equity, and we are a syndication company based out of Minnesota. And we look at purchasing multifamily, self-storage, industrial, and warehousing projects throughout the U.S. A lot of times I get the question of, what is a syndication? Oh, no, we'll go to the next one. What is a syndication? And in essence, it's the pooling of resources, both experience and capital, to purchase and execute a business plan. And a lot of times we'll drive communities. We will see these large buildings and wonder, how did that individual have the money to purchase and manage that property? The short answer is a lot of times it's done through syndication. Two of the big terms that you'll run into a lot is like, what is a general partner and what is a limited partner? And the general partner, they are the sponsors of the deal. They're the responsible for finding and managing these properties and overseeing the acquisitions of them. For us, we'll analyze 100 deals with hopes of submitting an LOI on 10 of them, and maybe to get one of those deals. There's a lot of time and energy that goes in to make sure that it's going to be a good investment. First, underwriting it, and doing your due diligence, looking at the community, making sure that it's a growing community. So there's a lot of time that we spend to make sure that it is going to be a good one for us as a general partners to manage, and then for our limited partners to be able to share in the profits that are there. But the limited partners, they are the ones that provide the capital for the deal. So they typically have little or no involvement in the day-to-day activities of that project, and strongly rely on the general partners to carry out that business plan. In the lower right, I have a QR code. If you can see that, you can use your camera. You can scan it. I know on mine, I just push a little button. It brings me to that page on our website. But the first one on there is the investor questionnaire. And if you have any thoughts or ideas or wants to invest in any of the real estate projects that we have coming up, please fill that out. It greatly helps us know your investing criteria, what you're looking for, timelines, etc. So if you have a chance, please do that. If you can't get the QR code to work, feel free to Google or look up Blue Skies Equity and go to the contact us, and it'll bring you right to that questionnaire. So with that, I'd like to go to the web, or go to Jodi and her presentation of cost segregation as a competitive advantage. And just to give you a little bit of background there, we had Jodi and her team at Cost Segregation Services Incorporated do a cost segregation analysis for us. And it was huge for us. And always a disclaimer, we're not CPAs, we're not attorneys. Definitely, if you look at doing one of these, be sure to consult them just to make sure that this works for you. But for us, we're maxing out paying into the government through our W-2, contributing significantly in quarterlies. And through this cost segregation over the last year and into this year, we will not need to pay in quarterly. So it has been great. We're thankful for the work that Jodi and them did. So with that, Jodi, I'd like to turn it over to you.
Well, great. Well, thank you again, Mike, for having me. Hopefully everyone gets a little bit of tidbit to leave with this. It's like Mike said, I've been able to help a lot of people and just kind of give it a comfort zone. Cost segregation, the concept has been around since 1997. My company, we've been around since 2001, and we've done over 44,000 studies nationwide. And I bring that up because probably a lot of you are from Minnesota. I probably have clients in 43 states now. So this works on any type of building, self-storage, apartments, office, retail, golf course, you name it, it works. As long as it's not your permanent residence. So if you have the Airbnbs or VRBOs or something, all works. I'm just going to keep put my finger up and he'll move on. So So basically, we are not filing taxes. We are never in competition like with your tax professional. We are an engineer-based consulting tax firm. So we work hand in hand with your tax professional, giving them the engineered calculations that they need to apply for you to take the benefit of accelerating depreciation in your building. And kind of, you know, the rule of thumb a little bit is for every 500,000 of building, the tax benefit to you is going to be between 30 and 80,000 K in tax savings. So I don't know who's on here that I don't know how it didn't come up here, but if anyone's over 30, you probably remember 2 whole beef patties, special sauce, cheese, pickles, and a necessity bun. It didn't come up here, but basically the slide normally shows it all broken down, the 2 whole beef patties. Oh, there it's coming. Straight line is just a straight hamburger, $3.90. It'll pop up here. That's what you're doing when you're straight lining a commercial building. 39 years, you get a little money every year. We come in as engineers and we break that building, every little inch of it, into what we can put into 5, 7, and 15-year property that you're able to accelerate. I wonder why this is being so delayed. Anyway, there you go. So, and those people under 30, it's a Big Mac broken down. All right, next one. So here's just a couple of examples of different types of buildings. Land itself, just so you know, doesn't count. So typically, you know, I'll always ask, you know, does your deal include land, which typically it does, and sometimes it doesn't. You might have already owned the land. But landscaping, outside, fencing, driveways, sidewalks, we love all that stuff. That's great for you. And you can see, I mean, the ROI is always going to be fantastic for you. And it just depends on what you have going on with your building. So next. Self-storage, another, yeah. So basically, the triangle, I really like this triangle. The cost segregation is the basis of what your building consists of, what we put in the different categories, which I'll show you some examples coming up. We also do what we call scrubbing your schedules for what's called tangible property regulations. And basically, this is a great thing for you because you may have made past decisions where you capitalize things that you should have expensed and will make you compliant. And then moving forward, after you do a cost segregation study, you're going to get more, to be able to expense more because of having done a cost segregation study using the TPR RID. And I'm not going to go down kind of, I'll say, the rabbit hole with that, but your tax professional will be able to use our numbers and help you. Now, bonus, what is bonus? And a lot of people are hearing about bonus or whatever. So bonus depreciation is whatever we find that's under a 20-year life that you can accelerate. Bonus is how much you can use the first year. Now, bonus in 2023 has gone down to 80%. And some people are like, oh my, that's, you know, that's not what's happening. It's not that big a deal. Prior to 2017, September 28th, you had to have built something new. And at that time, it was only at 50% bonus, and they were saying they were phasing it out. Well, then they came back in March of 2018, and they said, oh, wait a second, as long as it's new to you, everyone gets 100% bonus again. And that's what's been in place up until 2023. Next 2024, they're saying it's going down to 60%, and they say they're phasing it out. They've done this 4 times. Typically what will happen, and we all have an election year coming up in 2024. I'm not, you know, a rocket or fortune teller or whatever, but I kind of see it coming back. But again, if you never lose anything, so basically if I got you 100,000 of benefit, 100% bonus, you could use that whole 100,000 if you could use it this year. At 80%, you get to use 80,000 this year. You don't lose that 20,000. It's just going to be over the next 5 years. So don't get hung up on bonus. It's really not that big a deal, and cost segregation is always going to be good for you if you hold a building 2 years or more. Now with bonus being at 80%, the IRS might be saying hold it for 3 years or more, and that's just for the recapture. But doing a cost segregation study, you're accelerating this depreciation. It's going away, so you're not paying recapture on what you've already depreciated. So that's where we come into play a lot. Cost segregation is not for flippers. I would tell you, there's just not enough time to take your money. So let's go to the next one. So, whoops. It's gonna probably pop up here in a minute. There we go. Straight line is 26,000 on this building when it was purchased. Now it's going to show accelerated is 154,000, and then we're going to get bonus. So now we're at 1.735, what you can use. Now that's a big difference, right? And when we do your free analysis, to show you what your benefit's going to be, you're going to be able to see all of this all in numbers according to what your building is. Next one. So people often like, what is 5-year? What is 15 years? So 5-year, kind of in a nutshell, just think of it as kind of anything inside the building. And then 15 years, basically going to be anything outside of the building. And then the 5-year, you can see the graph. 5 years, just you bleeding, blah, 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 a little bit of money every year. What we do is we come in and we top end it. An easy example I like to tell people is kind of think of, if you won the lottery and you won $1 million, I said, well, hey, do you want a little bit of money every year for 39 years, or residential would be 27.5 years, or do you want a whole bunch of it now? Well, you want a whole bunch of it now. It's time value money. What can you do with your money now to make more money? And, like Mike is doing, people are taking this cash flow that they have and they're reinvesting it to make more and more money, which is a smart thing. All right, next. So what people don't think about a lot of times is you've owned this building for, say, 20 years. There's really no depreciation I'm going to be able to help you with at that time, but we always look at your schedules, your depreciation schedules. What have you done over those 20 years? What if, let us see, we could probably come back and cost save that. Partial asset disposition is basically dollars in the dumpster. You and I and your CPA would look at that pile of stuff. We'd be like, well, what we're able to do as an engineering firm is we will find money. That's all worth something, even though you're carrying it out. What we do want to remember about partial asset disposition is the building needs to be in service. You have to have owned it 1 tax year. So if I bought something today, what's today, August 29th, I just have to get to December 31st. If I start doing my tear out January 1, I can get partial asset disposition. So you have to have owned it a year. You have to have been through 1 tax year, not month to month, just a tax year. And you have to take it the year you do it. So if you remember anything about doing any major improvements, just go. She told me to call her or call somebody that knows cost seg, and I'll take it from there and help you. But when you tear things out, take care of it that year to get your money, because it's a use it or lose it. So next. Oh, interior renovations. Yeah, we kind of went. And you get 80% bonus on those. Yeah. So, yep, savings at the time. Yep, increased cash flow. An annual election must be taken the same year as we talked about. And again, it's just more cash for you. It's kind of like free money. And I hate to say the money, free money, but it is, because if you didn't take it, you don't get it. The other thing, if you think about a building you own, you're sitting on money. All we do is get that money out for you. Anyone that owns a building. So next. You want to, debt service, working capital, pay down other debt. Bankers like us because, especially if you're trying to get a loan, it does help if you have a smart banker that tells you, if you tell them you're doing a cost segregation study, because they want to make the loan, but they also want to get paid back, right? So they know if you're doing a cost seg study, you have cash flow, at least for the first year or 2 or 3, whatever. Okay, next. And so there is also some misconceptions. So I just always want, like, oh, my building needs to be at least $1 million. Well, that was way back, 1997. That was definitely true because it was all pen and paper. Literally it was, engineers had to be there for 2 weeks at a building site. Now we do come out, we are engineered based, is what the IRS prefers, which is what you want, especially with the new auditors coming in with the IRS, or they're already coming in. If you've owned the building, like I said, whether I don't care how long, let us just look at your schedules. If there's nothing there, great. If you're gutting a new building or a new purchase, let us know. There, you might be able to do something this year. If you can hold off to do something with it, get the benefit this year. And 2024, we come back in and do a phase 2. You build an addition on your building. So kind of just think anything you have with the building, you should probably be looking at, hey, is there a benefit to me? And it doesn't ever cost anything to look or to have us run anything. Like I mentioned, we do a no charge, no obligation analysis. Typically, we will ask for a depreciation schedule if you've owned it more than a year, or a closing settlement if you just purchased it this year. And if there's any brokers or anything on here too, I'll do a pre-analysis for a lot of people to have with the building you might be trying to sell, or even if you're here just looking to buy and you want to see, hey, if I bought this building, what would my benefit be? I do that all the time for people too. So it can really help maybe in some negotiations if you kind of are in a should I buy it or should I not? And if you could get $300,000 the first year, well, hey, maybe I'll pay the extra, whatever, 30 grand they want. So next one. So here, and I apologize, it's a little fuzzy, but this was a typical, like what an analysis would look like on a building. And just kind of so you know what you're looking at, the date acquired, obviously the tax year would be using it for. The straight line method showing 26,830. You get that no matter what, whether you talk to anybody doing cost seg or not. Now the 100% bonus is because it was for 2022. We'll come back to that in a minute. On another slide, it'll make a little more sense. But the benefit to what I would say to the client is what you're looking at is this $296,069. That's what we're going to lower your income by because we're accelerating the depreciation. And then the tax benefit savings you're getting is $109,545. And that's used against your tax liability. So how that works is basically, because this was 2022, if you owed $109,545, you wouldn't write a check. You get to do whatever you want with that money. If you owed, $50,000 in taxes, you don't write a check, and that remaining $59,545 sits, I'll say, in the holding queue with your tax professional until it runs out. We try to be conservative, not ultra conservative, but conservative on our estimates, just because we would rather over deliver. We hit our numbers 98% of the time, or over. So we much rather do that. I should also bring up at this time, sometimes people are very, oh, what if I get audited? Is this going to cause an audit? Oops. We've never triggered an audit in 44,000 studies. In fact, it's kind of the opposite. Our work, your audit defended the life you own your building at no extra charge. There's no extra charges for travel for us or to do the site survey, any of that. And we have tax professionals and attorneys, always no charge to you or your tax professional if there's questions, because like as Mike brought up, some of these syndications are very complex sometimes, and there's a lot of players that have different things going on. So if I can't, I try to answer, but again, I'm not a CPA, I'm not an engineer. I'm the conduit kind of, but we can answer any questions. Never been one we have not been able to figure out for anyone. Okay. So this is kind of the breakdown, and I kind of apologize. It's a little bit blurry, but basically, the upper left-hand corner is showing you 8% going, I believe it says 8% into 5-year and like 10% into 15-year, and that leaves that remaining 82% in straight line. And I do bring that up because sometimes people are like, whoa, don't take away all my depreciation. What am I going to do, 5, 10, 15 years down the road? And the two middle columns are kind of the important ones. You can see the first year is like 223,399 as compared to 26,830. And then the next year, if you didn't use me, because you're going to get a full year of straight line, if you weren't using somebody, not necessarily me, you'd get 42,000, like 661. And by using front loading it the first year, you've got 35,140. That's going to sit there in straight line for the rest at the end of the life of the building. Your dollar amount's all the same. So next. So here's another one. This is a retail warehouse, kind of the same thing. And you know, straight line was going to be 30,672. Up, lower your income by 451,291, and then the tax benefits 166,978. And again, if you have more than, you know, like let's say there's 6 players and you guys all own different amount percentages of this building, you just get the benefit to what your percentage is. Now, sometimes if somebody can't use the benefit or they don't want the benefit for whatever reason, there's different things. There is ways that you can sign it over to another partner. And that would be talking to your attorney and your CPA, but you can do that as well. Next. And this one, again, now this one is quite a bit of 15-year property because they had a huge parking lot. I'm assuming, Washington Avenue, yeah. So a lot of outside stuff. So 15.5% was a 15-year, and there's a small amount in 7-year, and then 5-year, I believe, was like 8.4%. And then again, we can look at those two like middle columns. You know, the first year you're getting like 481 compared to 30,000, and then subsequent years you would get 48,000 straight line and 37,000 with using the top loading cost seg. Next. So here's kind of a breakdown. This would be one of the pages of the finished study. So this had disposition in it too, so we'll talk about that on next slide. So that's your building cost minus the disposition, but we're going to get you money for that. So 8.4% of the building is 5-year, 0.1% is 7-year, 15, as you can see, 15.5, so leaving 76,000 or 76%, excuse me, going to be 39-year straight line. The next slide. So when you get our study, this is your tax professional wants two things. They want the number. What was the number? What was the actual tax benefit to you? And then they want to see this breakdown that they're going to put in their software. Now, why this is important is, again, is those TPR regs I talked about. Basically, the TPR regs, that's the time here, you're going to be able to make more expense decisions because of these numbers here. And that your CPA is going to like and you're going to like. Next slide. Now, this is a good slide too, because this is showing the replacement value. I would tell you, after you've done a cost seg study, that you should talk to your insurance carrier. And the reason I bring that up is because a lot of my clients are, excuse me, getting lower premiums. And the reason why is, easiest one is, you know, God forbid, a fire. But if you have a fire, you are not arguing with, or not arguing, I'm not putting insurance companies because they're great. Most of them are really great. But there's not a lot going back and forth because it is what it is. We're not aggressive and we're not passive on our numbers. It's all engineered based numbers on how we came up with our numbers. And we in our study, we show exactly how we did our work. So $78,234.29, that is what your ceiling system for this building would cost to replace right now, today. And then when inflation, whatever it is every year, that just gets added to whatever the replacement would be. Now, I can't guarantee you're going to get a lower premium, but a lot of insurance companies see that it costs them less to have adjusters coming out all the time and everything. because there's nothing really to talk about. Next slide. And so again, what we did with roof replacement, you can see that 16,944. Now the new base is 98,000, and that's 100% at 39 years. Okay. So total building cost over 39 years, 100%, kind of the same slide. So let's move on. Okay. Now, but we removed 55,000. So this is where we're going to be able to get you money because of what was removed, the disposition. So move on. And that's where, so the 16,944 came in to remove it, but you got the 55,000. So what we did here is the actual tax benefit from that disposal of that was 19,716. So like if you wouldn't have had this study, there's no way anyone would have been able to get that, because roofs can have up to 26 layers. I'm not a roofing expert, but the people that figure this out for us are, and that's, I'll say again, it's not free money, it's your money, but you could have missed out on that if you wouldn't have had this taken care of the right way. Okay, next slide. Okay, and that's just the cost of what one of the studies could be. This is what you would get. You know, it's going to tell you your 5-year, and again, everything's broken down right there for the CPA to be able to look at and to be able to put into your specific tax filing. Now, when you get our study, as I mentioned, you know, depending on how big your project is, it can be anywhere from 33 pages to probably 64. I like to tell people, you know, it's kind of like when you were in 3rd grade and the teacher asked the question and you bring up the answer. Well, the IRS does not care what number you give them. How did you get it? So it's like your 3rd grade teacher would say, show me your work. Well, that's what they want to see, is how did you ever get this number? And that's what we'll provide. So next slide. So that's kind of it. I know we were going to have some Q&A. So
Yeah, definitely. Yeah, thanks, Jodi. I do remember getting that report and taking a look at it, and I was like, wow, what do I do with this? And it's great that you kind of explained where this is just us showing our work, and that there's nothing for us. And yeah, it worked out great because you were able to give that information to our CPA, and they were able to take care of it. So that was huge. I'm going to stop the share. I can't see the chat. If anybody has any questions, please type them into the chat in the Q&A, and we can definitely answer those. I did have a number of people that weren't able to attend today, regretfully, but asked me to ask you a couple of questions, and then, as I mentioned, they'll be able to get the recording too. And yeah, Jodi showed her contact information too. So if you have questions, if you're doing a building project, and I've talked to you, a couple of you that are, so definitely reach out to Jodi with any questions that you might have. But one of them that I had is, and one I've heard quite a bit is there a total project cost where it makes sense to do a cost segregation? Have you kind of seen a certain dollar value where they should be thinking about that?
Yes, that's a really good question. That kind of goes back. I kind of missed that, like a misconception. So we can go as low as like 130,000 for a new buy or build to still be able to get you tax benefit for the cost of the study. Now, obviously, the more expensive your building, the more benefit there's going to be. Where this does kind of come into play a little bit differently, which, like, I just did like about 10 townhomes, and they were like 98,000 each, 89, 98,000, but they were bought together and they were on one parcel. So even though there was 6 different or 10, there was 10 different condos or townhomes, they were still on the same parcel, and so we could block that together because it was like altogether was like over $1 million something. They would each have their own separate cost report. So like if you have a property that has, you got your building, you've got maybe a shed, and you've got a garage, you get 3 cost reports for that, because each unit of property has to have its own. But yeah, you do want to look at, what, and that's where running the analysis is always a good thing to do, to see if, the benefit's worth the cost. I would bring up one more thing too. If you've owned a building more than a year, you've been straight lining it, we would do what's called a 3115 form. It's basically a form that tells the IRS that you're switching from straight line to accelerated. In 15 years, I've only had 3 CPA tax professionals that have wanted to do them. They're like 42 pages, but they like us to do them, get it off their hair, and then they just apply them when they file their taxes. Because that sometimes can be something, Mike, that people will be like, well, how's this going to work? I've been straight lining it. So we just take off. We can't double dip on what you've already depreciated the earlier years straight lining, but we'll start out where we are right now, and then we'll put what we can into those categories with what's left of your depreciation.
Perfect. And another one that there was, and you touched on this earlier on, do you guys work in all 50 states?
Yes, all 50 states, and even, the Virgin Islands. I did a hotel in, oh my gosh, where was it? But I can't remember where it was. But he filed in the United States. So even if you own property at different locations, now the tax benefit's not going to be, there's a lower, I don't know what they call it, international something. If you own property, say in Dominica, but you still file everything in the United States, there's going to be a little lower tax advantage because you can't use your set tax, federal and state tax rate. And that's what we use. I don't know if you remember one of those examples, it's at 37%. So depending on what state you are in, we use a combined fed and state tax rate. So like if you're in Florida or South Dakota, there's no state tax. So we would just use the federal, like a 23%.
Perfect. Got a question here. Can you explain the recapture?
Yeah. So when you buy a building and you hopefully are going to sell it for more than you bought it for, you have to pay taxes on that recapture money, capital gains, right? So if you have a building and you've been depreciated, let's just say you hold it for 7 years, all that 5-year property is already depreciated, no recapture. We're already into 15-year property by 2 years. So you're going to have to pay, like a lot of my guys say, well, I'm going to have to pay recapture anyway, but I'm going to pay less. So less is better, right? So that's where it comes in really, really handy for people to be able to do this. Depending on what your hold strategy is, like I said, the IRS kind of was, you should hold something for 2 years. I did have some people that they knew they were selling after a year. They're like, I know I'm going to pay recapture, but I can take that $300,000 and make a lot more money right now with it. Now with bonus being down to 80%, Mike, I think, that I haven't seen the actual what the IRS is saying, but I would imagine they probably put up to 3 years, just because now you're not getting that full 100%. But it's always something, I can have a call, run the analysis, talk with your tax professional. And the funny thing I always think too is, it's always like, okay, well, you're not planning on selling, right? But now all of a sudden, in a year or 2 years, someone's doubling what you paid for this. Well, first of all, you'd probably go like, what am I missing? Is this property on gold? And then if you find out, I don't know what I'm missing, but yeah, I'm going to sell it to you. You don't probably care because you're going to make a lot of money. And that doesn't happen too often, as probably all of you know. And right now it's a little, everyone's looking for a deal and interest rates and all that. And Mike's your guy, because I mean, this is what they do. They're out there, you know, talking to people and finding out what's going on. So
Yeah, definitely. Thank you. Uh, another question is our CPA hasn't mentioned cost segregation to me. Is this common, or is there additional work on their side, or why haven't they kind of brought it to light?
well, I'll go back with my own example. 15 years ago when this was brought up to me, and I have property, and I was like, went to my CPA, and I was like, well, what is happening? Why don't I know about this? It's like, well, we can't do it. And so really they are so busy keeping you and I and their two other clients out of jail. I mean, that's really their job, right? Until they actually meet someone like me or a company like ours or somebody that does it, they've gotten a lot better because it's gotten much more emphasized as far as doing it, but they don't want any more work. And some of them thought it was going to be more work, but when they work with us, like Mike, I think you could probably, agree with, like, they see that all these numbers are all figured out for them. Their life is easier after us. And that's how we try to make their life as easy. Yeah, CPAs are awesome. They are a friend. I mean, I try to describe it as like a pizza or pie, whatever. We're just one little slice. They know all these other things about you. And sometimes it's a timing thing. Like they'll be just like, you don't maybe need the tax benefits this year. Wait until next year. Like I just had a guy this year that he happened to do 2 buildings that he wanted to do, but he knew he wasn't going to use one. Even if you do a cost seg, he knew he was not going to use the benefit from one of his buildings this year, because next year, for some reason, he knows he's selling a bunch of stock. I don't know what that's all about or whatever, but he knows that he wants to have it ready because his income's going to go way up, and he wanted to have it ready in the coffer. And it's not hurting him this year. He's just getting a little better than straight line depreciation. It's getting accelerated. So yeah, I would say, timing can always be, something. Timing is another thing too, and I will, because we just have we have some time here, a minute. This could be like a succession plan too, and a lot of real estate attorneys, I think Mike, you and I talked about this, they kind of, some of them have really gotten on board with this, and real estate attorneys, because you could, we'll say dad does a cost seg study on his building. He did it 5 years ago. Now dad puts the building into a trust. The trust gets the stepped up basis and gets the cost seg tax benefit. And now, we'll say 5 years from now, dad passes away. Now the inheritance of the trust gets the building at the new stepped up basis, and they get the cost seg tax benefit. So the same building, the IRS just looks at whose hands did it change to, who's the new owner. Now I will say something about the stepped up basis. They have talked about that going away. And what that means for anybody is, let's say dad bought the building for $500,000. Now it's worth $1 million when it goes into the trust. So the trust is getting the $1 billion for the benefit. And then 5 years from now, if they keep the stepped up, I'm making up numbers here, but 1.5 mil, then the new owners get it. Now, the only thing with the new owners getting it, when it comes out of trust, is, are they going to hold it? Sometimes the kids maybe don't want to hold it, so then they probably wouldn't want to do a cost seg. They want to sell it. But a lot of them are like, whoa, why wouldn't I? It's a cash cow. Someone's leasing it, it's a triple net lease. That's great. Ooh, I just thought of something else. Can I say something else?
For sure.
Okay. So if you own a building and you lease it, if you can negotiate your leases that you are going to do the build out, take advantage of that. Because if I own a building and I'm going to charge, Mike's whatever, and he tells me he's gonna do 500,000 build out. So his rent is lower to me, right? He is going to reap the benefits of that 500,000 probably with QIP, which is qualified improvement property. However, if I tell him, you know what, I'll pay for your 500,000, you're going to pay me whatever $5 extra a square foot in rent, I now get to cost seg it and I get the tax benefit. So it's a strategy. And obviously you want to lease your building, so you want to negotiate whatever's going to be the best. I mean, if they really want to do their build out and they're going to lease, well, probably that might be better, but.
Right. No, that would be a great strategy. And yeah, like you were talking earlier, you know, just having that team, you have your CPA, have your cost segregation professional, your attorney, you know, it's all part of a bigger team to talk about your long-term plans with the building, succession, everything that can all really play into decisions that are made. I do have one more, and you did kind of touch on that earlier too. But if you own the building for, you know, 2 to 3 years, can we now do a cost segregation on that property?
Yes, absolutely. That's kind of, I'll even say, I mean, sweet spot is probably buy it, build it, start with cost seg, but you don't know what you don't know. I mean, that's what I tell, you know, people all the time, you know, if you don't know about it. So yeah, you've owned it for 2-3 years. Yep, we'll run the analysis. You'll send me the depreciation schedule. We'll do the 3115, tell the IRS that you're switching to cost seg, or excuse me, to accelerated depreciation. And it's, yeah, I mean, it's always good to look at everything, and, you know, it doesn't cost anything, I mean, to look at it. And I know we had talked about maybe bringing up, I know I said I had some pricing on there, but just kind of an easy way to think of it. I don't set the prices, but I've been doing this a long time because I know this is something that I wanted to know, and most of the time my clients, well, what's this going to cost me? So I'll use $1 million warehouse and $1 million office building. Again, both bought same year, both worth $1 million. So the $1 million warehouse is probably going to get you, let's say, $40,000 of tax benefit, and maybe the cost is going to be like $4,200. The $1 million office building is probably going to get you $85,000 because there's just more stuff in it. There's more stuff that we can accelerate, and that's going to probably cost you, let's say, $6,800. Now, those aren't set in stone, and I mean, I don't want to remember, but you know, just kind of give you but the ROI is fantastic. Like, you know, it can be sometimes 100 to 1, you know, or 20 to 1, or 40 to 1, or, you know, now obviously on lower, you know, $150,000 condo that's an Airbnb, it's probably, you know, it's probably going to be like a 9 to 1 ROI. But I mean, still go to the racetrack every day with those odds, right?
Yeah, exactly. I know that's the glory is if they have a property to contact you, and you guys can take a look and see what that ROI is and see if it makes sense. That's great. Well, we do not have any more questions. I do want to thank everybody for coming, and again, we'll send this out as a recording. If you have any questions, definitely reach out to Jodi and or myself, and yeah, it'd be fun to connect and talk.
Yeah, thanks a lot for having me here. This has been great, and hopefully it wasn't too much information. I mean, I don't like to try to go down the woods for everyone, but I do appreciate you inviting me. And yeah, and if you need any syndication, I will tell you, Mike's a great guy to connect with.
I appreciate that, Jodi, and yeah, we appreciated your help, and yeah, you just keep it so simple. And our CPA was thankful for it. So no, like I said, definitely reach out to us, and we'd love to answer any questions you guys have. So thanks, you guys.
Thanks. Have a good one.